You know, back in 1977, Warren Buffett penned a shareholder letter that was, well, it was more than just a profit report. It was basically a blueprint for building one of the most successful companies the world has ever seen. And the crazy part? That blueprint, from all those decades ago, is just as powerful today.
So, what was the big number? Almost $22 million in operating earnings. I mean, that's a solid performance for sure. But here's the thing. That number, as impressive as it is, it's not the real story here. Not even close. The real gold was hidden between the lines of the letter itself.
Yeah, the true value wasn't just the profit, it was this incredibly clear vision for the future. So what were these big ideas? What was the secret sauce that really built Berkshire? We're going to break it down into 3 critical takeaways from that very letter.
All right, first up, and this one's a biggie. It's like a lesson in business physics, you know? It's all about the huge difference between fighting an uphill battle and having the wind at your back.
So, in the 77 letter, Buffett paints this picture. It's like a tale of 2 completely different businesses. On one side, you've got the old-school textile business. Man, they were struggling, fighting for every single dollar. Buffett called it strong industrial resistance. But then, on the other side, you had the insurance business, and it was absolutely booming, just riding this massive wave of growth in a way better environment.
And this stark contrast led to, honestly, one of the most famous lessons to ever come out of Buffett's letters. He put it so plainly. He said, management had to learn, and sometimes, relearn, just how crucial it is to be in a business with a tailwind pushing you forward instead of a headwind holding you back.
And just look at what that tailwind actually looked like. In a single decade, their insurance premium volume shot up by almost 600%. Think about that. This wasn't just about making a profit. This was like rocket fuel for the entire company. All that growth created this huge pile of cash just waiting to be invested. Which, of course, brings up the next big question, right? What do you do with all that money?
Okay, so you've got all this cash pouring in from the insurance side of things. Where do you put it to work? Well, Buffett wasn't just, throwing darts at a stock market page. He laid out a super clear, super disciplined philosophy for how to actually buy pieces of great businesses.
And these are the 4 rules that basically became the Bible for value investors everywhere. What's so amazing is just how simple and business-focused they are. This has nothing to do with fancy charts or trying to time the market. It's just 4 common-sense questions. Can we actually understand this business? Does it have a bright future? Are the people in charge honest and good at their jobs? And can we get it at a great price?
And look, this wasn't just some abstract theory. You can see it in action in their actual holdings from back then. Take the investment in Capital Cities Communications, for example. Now, Berkshire probably could have tried to buy a media company themselves, but Buffett looked at the team running Capital Cities and thought, wow, these guys are so good, we'd actually get a better result just by investing in them and letting them do their thing. And that simple observation leads to a pretty revolutionary idea. And here's the quote that sums it all up. He realized that sometimes the smartest move a manager can make is to, well, not manage at all. It's about finding the best people and trusting them to do their job.
Okay, on to the final piece of this blueprint. And this is all about how you keep score. I mean, how do you really know if the management team is doing a good job with all that money they're investing? Buffett's big argument was that pretty much everyone was looking at the wrong number.
So here's the deal. Back then, most companies were obsessed with growing their earnings per share, EPS. But Buffett saw a huge flaw in that. See, a company can make its EPS go up just by holding on to its profits, which then grow the company's capital base. It's kind of like a savings account that earns a little more interest each year just because the balance is bigger. He argued that the real test, the true measure, was return on equity, or ROE, which shows how well management is actually using the money it has to work with. And when you look at that number, Berkshire was knocking it out of the park. For 1977, their return on beginning equity was 19%. That right there, that was the proof in the pudding. It was the definitive sign that their whole strategy, find the tailwinds, invest with discipline, was working. And not just working, but working exceptionally well.
I mean, with that single statement, Buffett was basically changing the rules of the entire game. He wasn't just suggesting a new metric, he was setting up return on equity as the ultimate scoreboard for judging how good a management team really is.
So there you have it. That's the 1977 blueprint. And it's not just a list of ideas, it's a complete, interconnected system, right? First,
You find a great business with a tailwind to generate a ton of cash. Then, you smartly put that cash to work in other great businesses, following those strict 4 rules. And finally, you measure your success using the metric that actually matters.
It's a framework that is just so simple, but so incredibly powerful. And it really leaves us with one big question to think about, doesn't it? In a world that looks almost nothing like it did in 1977, how can these foundational, powerful ideas about business and investing still help guide our own decisions today?